All right, students, welcome back. Let's dive into lesson 12 on business formation strategies. And our objective for this lesson is to educate you all on the different and various types of business formations and entities and the best practices associated with each entity and structure. All right. So typically, and there's some breakdowns, there are 4 types of ways you would legally form a business entity, right? And so those 4 types are sole proprietorships, all right? You have your sole proprietor, you have your partnerships, you have your S corps, and you have your C corps. And so during this lesson, we're going to be talking about some of your best practices with each. Obviously, we've talked about our recommendation for the LLC, which again gives you some different flexibilities within each of these different types of entities and structures. And we'll talk about some of the pros and cons of each structure as we go along. Now, get my game right. Now, when we talk about our sole proprietorships, our partnerships, our S corps, and our C corps, we're going to dive into the sole proprietor first, and we'll be getting into some of the pros and again, pros and cons of each. Sole proprietor is one of the easiest ones to kind of zip through, and we're going to be talking about liability here. We're going to be talking about partnership models, taxes, ownership, and again, I am not a legal counsel. I'm not a tax strategist. I am just a businessman and a coach and a mentor, and we'll give you some best practices and things that I've seen in the industry, been advised of in the industry, and just some general recommendations. I do always encourage you to spend the extra time, to spend the resources, to counsel, consult with your advisors, with your team. But again, I can give you some very sound best practices, some whys, some do's, some don'ts, based on what I've been seeing for decades now in the industry. So on the sole proprietor front, it's very, very simple. As a sole proprietor, it's not a partnership. Sole meaning you are the single owner, all right? So we're talking about the sole proprietor. You are the single owner of the business, and with that single owner, everything that is you are business liable for, you are also personal liable for. So from a tax perspective, from a liability, lawsuits, debt, any of that, everything you do as this single owner, everything that happens in the business, you personally are also liable for, right? And so it's not a preferred method. Now, this is one of the cheaper or most inexpensive ways to start a legitimate business entity, but it also, again, it just does not mitigate your risk or your exposure. You are heavily exposed, right, in a sole proprietorship. And that's what we want to get around. We want to minimize our risk and our exposure, okay? And so because this next one's a little deep, we're going to flip the page. And we're going to talk about different types of partnerships, right? All right. So in partnerships, there's 2 types. There are LPs, right? Limited partnerships, and then are LLPs, which are limited liability here we go, partnerships as well. So we'll abbreviate that. So in the LP portion, right, the difference in such, and again, we'll talk about recommendations in a little bit, but on the LP side is you can have multiple members, but there will be one general partner, right? And then you'll have other limited partners, right? It can be more than one, but this general partner, right, in the LP structure does take on tax liability, right? And is really unlimited in liability whatsoever. So there is very little protection for the general partner in this LP structure. And the other members who are the LPs, they will have limited liability when it comes to tax, to debt, and they are individually taxed, right? Whereas the general partner here is personally taxed, and their portion of the business is also taxed in a limited liability or a limited partnership, right? In an LP. So now we come down to the LLP side. This is very close and to what we choose from a tax designation under the LLC side. And so all the members of the LLP, limited liability partnership, they all are not taxed on the company side, but they are taxed, right, as individuals. All right, so they are taxed as individuals, and there is no partnership liability as well, right? So there's very, very limited liability in debts and lawsuits, etc. So it gives you more protection on an individual level. And all this is about is, again, how we minimize risk, mitigate risk, and limit our exposure, right? And so I'm going to come back to the LLC in a second, but let's talk a little bit about the C Corp. And within the C Corp structure, the partners or members are considered user owners. And these user owners, the way it's typically run is that in a C Corp, you typically have a board of advisors. This board of advisors makes the decisions. They have the management rights and decision-making rights, typically under the company. The members do have some level of voting power over who's in the board of advisors or with the board of advisors. They do have some voting power as to decide who the decision makers are going to be. The amount of shares that they own in the company do not impact the vote. But in the C Corp, the members are taxed twice. You are taxed at the corporate level and in the individual level. Right? Under the C Corp. And so, again, there's a little more tax liability and tax exposure under the C Corp mechanism and or structure. And then we can get some general understanding on the S Corp, which is somewhat similar to the C Corp, but with the S Corp, there could be no more than 100 members. They must be U.S. citizens. And with the S Corp, you pay personal tax only as opposed to being taxed at the corporate level and individual level. So and these are one of the more expensive filings for a particular corporation. So these are the four main entity formations, but then we get into the LLC, or the limited liability company. And the cool part about the LLC is with the LLC, it protects, and this is why we highly recommend it, and why I guess my advisors for decades now have shied me away from the S Corp, the C Corp. And there's a time and place for them, I suppose, but in all my successful endeavors and all my attempts at successful endeavors, I've never been recommended into diving in or choosing one of the other entities or structures within my companies. But under the LLC, the greatest part is that you protect your personal liability. So your personal liability is protected, and the business takes on a majority of the liability of debts that may be owed, of lawsuits or litigation, right? Of bankruptcies, BKs, etc. And the profit and losses of the limited liability company, as we talked about earlier in our lessons, those profit and losses flow up to the individual and is not taxed at the company level, right? Which is one of the benefits of the LLC. And from a tax perspective, if your tax strategist sees an advantageous reason as to why your limited liability company should take on another type of entity tax designation, you also can choose how you are taxed at some point under the LLC as well. So it's all about flexibility and limiting our risk and our exposure, right? And so again, this is where we don't have to know all of this. We don't have to know every intricacy of it. I personally don't even care to waste my brain cells in learning about all the other entities. I want a general knowledge base, so I'm well informed of new strategy, but I'm more concerned with being an expert at hiring experts, making sure that I can hold my experts accountable towards good information and good strategy. So we do want to be generally knowledgeable. We don't want to be ignorant, but we do not have to be super proficient and efficient in every single part of entity formation, tax code, legal code, etc. We'll find our niches, and we operate to our strengths, and we hire a partner to our weaknesses, okay? And so where this kind of takes us back to some of the corporate veil conversation that we were having in previous lessons is when we're talking about the flow through of profit and losses in the holding company. And giving our tax strategists, our legal tax strategists, the best chessboard. This is why the LLC structure is so important, because the individual has as much the most limited liability, right, to incur on many different levels, right? Tax liability, personal liability, debt liability, litigation liability, right? So that's why it's so important. And then you're able to have that into multiple business structures, and it's a pretty affordable entity for you to be able to create and to create multiple versions of the entity. And as you get good at it and your team gets good at it, again, you're here and you're going to pay tax at the personal level, but you are able to flow up, again, losses that may offset profits that your team can best calculate and advise on before they get to you, and your, again, personal liability in regards from a tax perspective. But the same thing goes if you are, getting certain debts or other things that may be happening within your business. And I guess one of the most streamlined ways to create a business, create a company that protects you from all different areas. And so again, unless you're getting some strong expertise as to a reason to partake in one of the other S Corp, C Corps, partnerships, or even a sole proprietorship for whatever reason, unless your strategists can make good sense of that, our recommendation is that you advise them to deeply look into the LLC structure and give you some feedback on why or why not that would be the best entity and structure for you. All right. And so we have some links and resources for you guys to be able to click to look at starting your LLC formation, right? And we're going to talk about branding and naming and all those things earlier. Just some tips for you as you go to register your limited liability company, if that's what you and your advisors choose. As you are building that business or registering that business, again, remember, if you have partners, make sure there's an operating agreement, right? So partnerships must, this will save you so much time and energy and money later, must agree to an operating agreement prior to you guys engaging and talking about, right? You get your terms first, agreeing your operating agreement prior to you registering the business. You do not want to put someone in your business as a partner and you guys have not ironed out and signed an operating agreement that dictates the terms, because now it's your word versus theirs. And it can be very messy, and it's easy when there's no money being made. Nobody cares. Oh yeah, I'll take 10, I'll take this, I'll take that. Trust me, I've been down the road. You start making money, and now the person that was just so happy to just be in the room and to receive 5 or 10% now grew a brain all of a sudden. All of a sudden they were just like, it's a whole new person. And now you got to deal with paperwork that supports what your allegations are, what you allege, right? So you must, as a partner, do your operating agreement. You guys, again, you want to go to irs.gov, to get your business EIN number. And we'll talk about a little more of that later. Your EIN number is your business tax ID number. This is like your business social security number, right? Right, for your biz. Once you get that EIN and social security number, and again, we have a whole business checklist for you. We got the resources for you. Once you do that, then that enables you to be able to get a business bank account. And obviously, you're going to need that first and foremost for your holding company, which is going to control the holdings of your businesses. But you're going to need that for your what's called subsidiary companies, or what we call SPEs. This is a term you should know and remember through life, is the SPEs, which are, and I'll just write it down here, special purpose entities, right? So you have special purpose entities that will function or have a specific function as a subsidiary company to your larger company. So all these are LLCs, right, with a special purpose, right? New business model, etc. And so they will have their own EIN numbers, right, and names as well, and inevitably their own bank accounts and financial reporting. You're going to have yearly registration, annual filings for the business. Otherwise, they don't get too expensive outside of upkeep on some of those filings. And again, any profits and losses will flow up, and it'll be like, unless there's a partnership. There's a partnership, you'll have a separate kind of tax filing. But if it's not a partnership, it's a single member, it'll all flow up, and you'll have one filing there. And then when you have these bank accounts, and we'll get into some of the operations later in our class, but from a business perspective, as we're in the B course of our RBCs, you want to hook up softwares or accounting and bookkeeping softwares such as QuickBooks, that simply will report your bank account activity, right, to an accounting software that will then keep track of all your profit. Well, it'll inevitably keep track of all your revenue that came in and the expenses that you spent from your debit card, from writing checks, etc. Your bookkeeper, sometimes your accountant will be your bookkeeper. Many times they'll be separate. they will categorize those expenses. So as these weird names come into your QuickBooks, you won't know what this check or debit card was for. This was for some gas. This was for Uber. This was for a marketing expense. You will help them categorize the expenses in the beginning, and then they'll get the hang of your common business expenses. If there's something they don't know, they will ask you about the expenses, because those expenses will be categorized so that you can have a full profit and loss statement, which will show you all the revenue that came in and where it came from, who paid, where it came from, what merchant account, and then all the losses, and end up giving you a total of a profit and loss statement that you can get weekly, monthly, quarterly, annually, etc. And so that's all part of your bookkeeping practice, and why it's so important to have a bank account, a business bank account, for any revenue that comes to that business. So if there's real estate attached to this business and you got a property manager collecting checks, those checks are deposited into your business bank account. That then will then go into your revenue column. If from that business you have to pay utilities, lights, water, or maintenance for that property, that will go into the expenses. And then again, that will create your business profit and loss. No different than if it's outside of real estate and you have a consulting company, a marketing company, or any other business. Again, wherever revenue comes from, your customers, from other businesses, from merchant accounts, online, cash registers, all that will go into your bank account, whether that's cash deposits, whether it's from your Stripe, your merchant account, your PayPal, whomever it may be. And then those things will be added up as revenue. And again, any debit card deductions, checks, payroll, any of those things would go into your expense column. And then you as a business owner will be able to look back later on, and we'll get to this in some of our later kind of financial accountability and tracking, but you'll be able to look back and see where you spent money, where you made money, where you can cut down on expenses, where you can increase on revenue, and that allows you, again, through proper reporting and analytics, will allow you to be able to maneuver your business better. But it all starts with your entity structure, how you organize your business, how you organize partnerships, and a lot of what we told you in our last lesson, and looking at partnerships, especially through the LLC structure. What are your partners contributing to your business, and what is their stake in profits, right? As well as losses, because usually the profits are equivalent to losses, unless you specify. And again, in your operating agreement, you can specify terms, whether it's, hey, they don't see any profits until we reach X amount of revenue, whether it be equity that they receive or bonuses, any future vesting of shares. And what vesting means is sometimes when you go into a new partnership, and this is, again, a little more advanced, but it's worth you all knowing, you may go into a partnership and you think someone has what it takes to be, a long-term partner, but you're a little unsure, and you want to kind of, feel them out, date a little bit, but you need them to kind of get started with you. So you may say in your operating agreement, and your experts will help you, hey, you know what? I'm willing to give you 30% of the business, but initially we're going to start out with 10% of the business, and then every quarter or every year that you're with the business, we will what's called vest an additional 5%, right? And so we'll do that 5% again. Now you got 20 for another year. So every 1 year, you'll get another 5. And so after 4 years, you'll get an additional 20% on the date of the anniversary, and you will vest your interest, right, over a 4-year period of your full 30%. And so what's called a vesting schedule, this also will allow you to be strategic and to minimize your exposure and risk in new partnerships. A lot of times we jump out the window, or we are really aggressive in a partnership because it sounds good, it feels good in the beginning, but we haven't necessarily dated this person. And partnerships truly are a marriage, sometimes that you cannot get out of. And they work typically easy when your business is new, or your business is failing, or the business is not generating revenue. But once money and revenue and capital gets involved, these things can become very, very heavy. So you can look at structuring a vesting schedule. And again, these are things that your experts, your coach, maybe me, maybe not, or your other advisors, legal team, etc., can help you structure based off of best practices. And this can be the same way for profits in regards to vesting, maybe you start off with one profit share as opposed to, and it can grow based on their work with the company. The same thing for bonuses. If you want to add any bonuses, right, or incentives, whether that be company reimbursements that you want to offer, right? So you may have one to kind of incentivize and give some incentives. All that will be spelled out in your operating agreement, as well as if someone gets sick or deceased or they no longer can function in their capacity in the company, what then happens, right? So company buybacks, if the company or members can buy back any interest or units in a particular company, all that is spelled out again in your operating agreement. And this is why you want to make sure that you have experts behind you so you're just not guessing or doing this for the first time or doing it from a place of you don't, obviously, again, have the experience or expertise. And so you want to consult your coaches, you want to consult your advisors, your legal team on what have you seen in the industry, what has worked for former clients, what has worked for you as an experienced coach in regards to how I structure these partnerships specifically. Now, if it's just you, these things, are, almost obsolete because it's just you. And then you'll have a will and trust to, again, talk about what happens if something happens to you in your succession plan and where your business goes to your heirs. But from an operating agreement standpoint, all these things have to be mapped out. And your legal counsel will be the one really, and your coach, to really help you niche down what are best practices, what is most advantageous to you based on your goals for that particular partnership, right? And so these, again, are just some angles, some avenues on things that, you all could do and should do. And forming your business is really an amazing thing to, create these companies, to bring them to life. We're going to talk about later lessons, how to make them, to dress them up, to market them, to brand them, to make them look pretty. And we already talked about, again, the organization that will support it. And is just, as a business owner who lives this in real life and does it and creating, the companies that we've created, and you watch your idea and vision come out of your head, and then you go through the proper research and development for that idea, then you birth it and legitimize it through a legal entity and structure, and then you create you have a business plan that supports it to take it to market, and then you start to market and brand it and give it some flow and infrastructure and process procedure. You make this business entity a real life thing, and then you watch that business serve people through either products, goods, or your service, and then it earns its own keep. And then we're going to talk about in later lessons how you turn these entities into automated businesses and systemized businesses that start to operate and function and maneuver without you. Similar to you birthing and grooming a child. It comes out, it is totally dependent on you, right? A child, a baby. And inevitably, you start to feed it, and it will learn how to feed itself, he or her. And then it needs you to walk and to direct it. And then eventually it stumbles and takes its first steps, and it begins to walk for itself. And then at some point, your baby is all grown up, and you can leave the room, you can leave the house or go on vacation, and your baby can take care of yourself, maybe with a little bit of management, right? A little bit of oversight, a little babysitter, and eventually it is a young adult or an adult that is fully functioning, and that is a baby that you one day could give away, right? Through marriage or otherwise, which is you leveraging or liquidating your company or allowing it to scale or grow through franchising, licensing, and other business opportunities. And so that's how we look at businesses, is seeing how we can be the parent to grow it up under our vision for how we want our child to turn out, how we want our child to impact the world, and how we want our child to continue extending our legacy. That's what all this is about, is creating an entity, a legal entity and legitimized asset that can be profitable for you, that can produce hopefully cash flow, revenue, and equity for you, that can impact the world in some kind of way, but also can be an asset for your heirs, creating capital, being a part of real estate, or just being a general business asset, again, that can produce for your last name or your kids, okay? And so rely on your experts, rely on your team. Go look forward to starting your business. Don't rush, right? Take your time. Let's do everything right over rushed. Double check everything. Hopefully we give you enough research and just educational collateral here to be able to help you perfect and hone your craft and to be able to be a check and balance for the experts you'll be engaging. You'll be getting all types of advice. You guys are going to be on YouTube and other platforms learning new information, but stick to the core curriculum and the foundation you got here at JMA Learning Your RBCs. See you next lesson.